Well, hello everyone. In our chapter 4 lecture, we're going to cover what's known as accrual accounting concepts. Are you ready? Let's go. We'll talk about the accrual base of accounting. What does that mean? And we'll focus on why we're required to do adjusting entries at the end of the accounting period. We'll then look at different type of adjusting entries for what we call deferrals and for what's known as accruals. We'll also look at prepare what's called an adjusted trial balance as well as what's known as closing entries. Okay. First, accounting information is divided into what we call some type of artificial time period. So think about your place of employment. How often are you paid? Are you paid weekly, bi-weekly, semi-monthly, maybe monthly? There's some type of time period used for your pay period. The same is true when it comes to accounting. We take our everyday business transaction and what we call artificial time periods. That could be a month, that could be a quarter, or it could be a year. So when it comes to accounting, if you are a public corporation, you must choose what's called your fiscal year. What's a fiscal year? A fiscal year refers to any 12 consecutive months that has been chosen as the accounting period for that business organization. So it could be January through December, could be the fiscal year. It could be from July 1st of this year until June 30th of the next year. But any 12 consecutive months chosen as your accounting period is known as your fiscal year. Okay? Question. What is the periodicity assumption? Is it letter A, letter B, letter C, or letter D? I'll wait. Okay. If you said C, that is correct. Again, it is the economic life of a business divided into artificial time periods. All right. Let's look at some principles, some accounting concepts. We have what's known as the revenue recognition principle. The focus is on at what point in time can a company recognize and record revenue? Again, when is it appropriate for a company to recognize and record revenue? The rule says recognize revenue in accounting period in which the performance obligation is satisfied. Perhaps you're saying, what does that mean? I am glad you asked that question. We're saying that some type of obligation has been satisfied for the actual consumer, meaning that perhaps I provide you with an actual service. If I perform the service and you're satisfied with that service, then at that point in time, I'm able to recognize revenue. Or perhaps I've sold an actual product. So once the performance obligation, which consists of typically providing a service or selling a product, once it has been satisfied, at that point in time, we're able to recognize revenue. We have a customer who requests service. Then we perform the service, and maybe later on we're going to receive the actual cash. So request came in from a customer. We perform a service. They later on paid us in cash. The question you would ask yourself, at which time are you able to recognize the revenue? Well, you're able to recognize revenue here when you perform the service because at that point in time, the performance obligation has been satisfied. Now, I understand we haven't received cash yet. That's not a requirement to recognize revenue. Under accrual accounting, you're able to recognize revenue again once the performance obligation has been satisfied. Okay? Assume we have Conrad Dry Cleaners cleans clothing on June 30th, but customers do not claim and pay for their service until the first week of July. On June 30th, the performance obligation has now been satisfied. So on June 30th, we're now able to recognize revenue. Now, because the customer hasn't paid us yet, they owe us money. You would debit the account receivable account for the amount that's owed, credit your service revenue account. When we receive the actual money in July, at that point, we'll debit the cash account and then credit account receivable. But once again, notice that the revenue was recognized in June because the performance obligation was satisfied during the month of June. Okay? Next, you have your expense recognition principle. We're saying at what point in time do we recognize and record our expenses? Well, the rule says match expenses with revenues in the period when the company makes efforts to generate those revenues. I'll read again. Match expenses with revenues in the period when the company makes efforts to generate those revenues. Let the expenses follow the revenue. What does that mean? This is saying whatever expenses incurred in order to earn revenue, record those expenses in the same accounting period. So if we earn revenue in the month of June, we're saying, are there any expenses that took place in order to earn that revenue? The answer would be yes. Then record those expenses in the month of June as well. So we're trying to match revenues and expenses in the same accounting period. And we'll look at examples of how we're going to match up expenses and revenue in the same accounting period. So we talked about three different principal assumptions: the periodicity assumption, the revenue recognition principle, and the expense recognition principle. We can combine these two together and call it the revenue expense recognition in accordance with general accepted accounting principles. So the rule says to recognize and record revenue when the performance obligation has been satisfied. Also, we're going to record the expenses and match them in the same period in which the revenue has been recorded as well. Okay? Next up, we have accrual accounting versus the cash basis of accounting. Again, the accrual accounting versus the cash basis of accounting. With the accrual basis of accounting, we study it right now, it just simply says recognize revenues when the performance obligation has been completed, such as a service being provided. Record and recognize your expenses once the expense has actually taken place or incurred, even if cash was not actually paid. So notice that for recognizing revenue and recording your expenses, receiving cash or paying cash is not one of the requirements. You want to recognize the revenue once you perform the actual service, even if you haven't got paid for it yet. Record your expenses once they have incurred, even if those expenses have not yet been paid. In contrast, we have what's called the cash basis of accounting. With the cash basis of accounting, it is contingent upon an actual cash transaction taking place. The cash basis says recognize revenue only once cash has been received and record your expenses only once cash has been paid out. Now, the cash basis is not in accordance with GAAP principles. The cash basis can only be used for smaller companies that are not public corporations. And that's because if you're a public corporation, most of your business transactions take place on account, meaning that when you provide the actual service or sell the product, cash is not exchanged at that particular point in time. So if you're a small business owner, you probably deal mostly with a lot of cash transactions. When I say cash, that has to be physical cash. It could be accepting credit card payments, PayPal, Venmo, Zelle, Cash App, if you name it. Those are considered to be cash transactions because you receive cash within a short window of time. But with corporations, when company A buys from company B, they receive what's called credit terms that allows them to pay for items over time. So the cash basis is not the best accounting system for public corporation because there's a lot of transactions that would not be recorded in the same accounting period because cash was not exchanged in that particular accounting period. So remember that for public corporation, they have to use the accrual basis of accounting rather than the cash basis of accounting. Let's look at one illustration, a difference between the accrual basis of accounting versus the cash basis of accounting. Suppose that Fresh Colors paints a large building in 2016. In 2016, it incurs and pays total expenses, salaries and paint costs of $50,000. It bills the customer $80,000, but does not receive payment until 2017. Under the accrual basis of accounting, we're going to recognize the revenue in 2016 when the performance obligation was satisfied, record the expenses in 2016 as well, and show a net income of $30,000. Now with the cash basis, notice that there's not any revenue recognized in 2016. That's because cash has not been received and the expense will be shown for $50,000. So on the cash basis, we will have a net loss in 2016 for $50,000 compared to the accrual basis, a net income of $30,000. Now on the accrual basis in 2017, there's no impact because it was all recognized in 2016, but under the cash basis, you would show net income of $80,000 when the actual cash was received. Now notice that if you net these 2 years together for the accrual basis and the cash basis over a 2-year period, they'll both show a net income of $30,000, but the accrual method is more accurate because it records the actual transaction accounting period in which they actually took place. Okay, that's going to end our first portion of our Chapter 4 lecture. We're going to come back and look at some what's called adjusting entries that we have to make with the accrual basis of accounting. Stay tuned.